Ms. Cobena, please, from the Conservatives.
Sure. Mr. Macklem, in your most recent monetary policy report, I'm going to quote a section there. It says, weak growth is likely in the second half of 2025. After contracting in the second quarter, GDP growth is estimated to be about 0.75% on average for the second half of the year. So when we look at it on a year-to-date basis, is it fair to say that performance is basically neutral for our economy? But of course, the Prime Minister is promising Canadians that he's going to be building the economy at unimaginable speeds not seen since the Second World War. So I did a bit of research, and it looks like Canada's GDP growth following the years of the Second World War were between 6 and 7%. So based on your forecasts, when do you expect that we would achieve that 67% GDP growth?
Our forecast goes out about 2 to 3 years, and we don't achieve that. We've got, I think, 1.2, 1.1, and 1.6 in 2027.
And what do you think the economy would need to achieve that 6 and 7% GDP growth?
Well, if we want much higher, growth in the economy, we're going to need much higher productivity growth.
Okay. So when I read the news, I see that auto manufacturers have relocated investment to the U.S., some big names recently. Housing starts in Toronto specifically are at 30-year low. Bottling companies are also moving operations to the U.S. And of course, small businesses have been heavily impacted because of the U.S. tariffs. Given that, do you believe that our economy is growing at unimaginable speeds, like the Prime Minister has mentioned?
At a what speed?
Unimaginable.
Unimaginable. Well, I'm not really going to put it on. I mean, you can decide on the adjective. I mean, our forecast is 1.1, 1.2, 1.6.
So, in simple terms, for Canadians watching, that means that our economy is not growing very fast.
No.
Is that fair to say?
No, our economy is not growing very fast. It's been hit with a major structural shock. As you indicated, growth in the second quarter was negative. Economy contracted 1.6%. That was largely as a result of a big drop in exports to the United States. We think growth in the second half of the year, which, we're in November now, so a lot of that's already happened, but we don't have all the data yet. We think it's going to be pretty modest, 0.5 for Q3, 1% for Q4. And that's really because, to get back to Mr. Garon's question, consumption growth's holding up. That's supporting growth, but exports and business investment remain weak. As you get into next year, we think there'll be some recovery in exports and business investment, so growth picks up. But yes, I mean, even 2027, 1.6% growth is not particularly strong.
And so you did touch on my next question a little bit. So your report mentions the GDP downgrade reflects lost capacity in a productivity crisis, of course, not a surge of growth. When I think of lost productivity, that's not something that is easily restored, of course, because oftentimes when I think of a business that's heavily or capital intensive, once they've moved operations to another country, very unlikely that they will actually return, predominantly in manufacturing. So how does the lost capacity and productivity crisis impact the overall growth of the economy?
Well, really, my point in highlighting that this isn't a typical cyclical, it's not a typical business cycle, it's a structural adjustment. Part of the message there is that it's going to take longer than normal because rather than sort of demand coming back and businesses have had unused capacity, they now put that, they bring workers back to work, they increase production, and everything bounces back. This, in a structural adjustment, you know, sectors need to pivot. They need to invest in new things. You know, they're going to be doing less of some things. They need to be doing more of other things. And that is going to take time. So that's an important reason why the pickup in the economy is relatively gradual.
Thank you, Ms. Cobena. That concludes your time.